Hello and welcome. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. Thanks for joining us today for the fourth and final webinar in our series on tax planning. Today we are discussing retirement and financial tax planning. A couple of things before we get started. If you look in the Q&A section, you will see links to our upcoming webinars if you'd like to register for those, as well as a link to sign up for our monthly email newsletter, which includes the latest accounting news, updates, and more. Now, let me introduce you to our awesome presenters today. We have Clayton Johnson, Nathan Larson, and Lincoln Fleming. Clayton is a certified financial planner and wealth advisor for Squire. His focus is financial planning for business owners. Outside of work, he enjoys playing and coaching volleyball and spending time in the mountains with his wife and twin daughters. Nathan is a CPA and wealth advisor for Squire. His focus is financial planning and tax. He enjoys helping his clients with all areas of finance and tax strategies. Lincoln is a CPA and tax manager here at Squire as well. He specializes in individual, gift, trust, estate planning, and compliance. And with that, we'll get started. Take it away, Clayton.
All right, thanks, Whitney. I'm excited to be able to present to you and talk a little about our financial planning process. Before we get into the details on specific planning strategies, I want to spend a few minutes introducing the big picture of financial planning and the financial planning process. Then Nathan and Lincoln are going to dive deeper into some of the more specific retirement planning strategies relating to Social Security, Roth conversions, and required minimum distributions. So for most of us, achieving financial comfort, planning for a secure retirement, reducing taxes, and building a legacy are all really important things. But most of us probably feel a bit unprepared or maybe a bit ill-equipped to deal with all these planning issues in some kind of coordinated or educated way. So at Squire, we build financial plans through a three-step approach called design, build, and protect. So when we're in the design phase of building a financial plan, we explore what matters most to us so we can draft and then build a customized financial plan that focuses on those values. Then we protect that plan so when the inevitable ups and downs of markets or life come, we're in the best possible position to reach our goals. Then within that design phase of the planning process, it's important to take a top-down approach that you see on this wealth planning pyramid. First, we identify the impact that we want to have on our legacy, our community, our family. And then as we work down the pyramid, we identify what kind of life we want to live, what values or causes matter most to us. Then we explore the goals that will help us achieve that life and have that impact that we want to have. Notice up to this point in the design process, we haven't even discussed portfolio or budgeting strategies. Don't get me wrong, they're really important components of the design process, but we need to understand the whole picture before jumping into these more technical aspects. I've made this mistake while working on home projects. I'll grab some basic tools and I'll start, only to realize 5 minutes into the project that I also need a drill or a wrench or something else. So I head back down to the garage for the tools. It seems that the bigger the project, the more times I'm heading down to the garage or even to the hardware store. And planning our financial future is a very big project. So we want to have a clear picture before identifying the tools we may need. Then once we have this clear picture, we can design the framework for what's called a life plan, listing out the causes, the relationships, values, and goals that are most important to us, our family, or our business. And it's not until all these steps are done that we get to the build phase of the financial planning process. Within the build phase of the financial planning process, we analyze a comprehensive list of strategies and then select the ones that will best help us reach our goals. To name just a few, we explore portfolio design, income generation, tax planning, insurance, Social Security. And so I want to talk briefly on one really important build strategy, and that's constructing our investment portfolio. For most of us, investing is what makes it possible to achieve our life goals. This is why we want to gather as many professionals on our side as possible. At Squire, our process incorporates the research of many great thinkers and economists, including pioneers in behavioral finance and 11 Nobel laureates. And decades of research from these great thinkers show how we may be able to actually increase our probability for long-term success. First, finding the right portfolio balance between stocks and bonds. Over time, stock markets have tended to reward patient investors. However, the price for these long-term gains can involve living through occasional periods of decline. So understanding our tolerance for these periods when the market goes down is an essential part of building a plan that will work for us. Then second, we want to diversify among international and US stocks. We like to think of the US as a world leader, but over the past several decades, America has never been the #1 market in the world in annualized performance. And third, we can potentially increase our returns by investing in riskier companies, like small and value companies. To be clear, all investing involves taking on some risk. However, the more risk we take on in our portfolio, the greater our expected return potential. The opposite is also true. When we take minimal risks in our portfolio, our expected returns are lower. Academic research has shown that stocks from different kinds of companies have different expected returns. For example, small company and value company stocks have greater expected returns and therefore greater risks than growth company and large company stocks. As an investor, we need to decide how much of these risks we're willing to take. It's important to recognize that long-term relationship between risk and reward doesn't mean that we as investors will realize higher returns from riskier investments every year. In fact, it may take years. You can't get return without risk. That's just the price of admission for being an investor. So just as important as deciding what to invest in is deciding where to put our retirement investments. There are 3 main types of savings accounts. The first category of accounts are taxable accounts, like checking and savings account or a brokerage account. These receive no preferential tax treatment. So when your investments that are held in these accounts pay dividends, interest, or have capital gains, you pay the tax on that income in the year you received it. And with these accounts, there's no contribution limit, so you can put as much money in these accounts as you want. The second category of accounts are tax-deferred accounts. These accounts provide an immediate tax deduction for the amount of money you put into them, and then you don't pay any tax on the investments until you withdraw that money at a later date. Now, the IRS has imposed certain restrictions like contribution limits, age withdrawal limits, and various other caveats to qualify for this tax deferral benefit. And the third category of accounts are tax-free accounts. These accounts do not provide any immediate tax deduction for the amount of money you put into them, but then you don't pay any tax on the investments in these accounts ever again. You can withdraw your money from them at a later date and it won't be taxed. These also have contribution limits, age withdrawal limits, and other IRS imposed caveats. How we split up our portfolio among these various accounts can significantly impact various aspects of our financial plan, like when we have access to our money and the taxes we may pay, which is why it's so important to choose these type of accounts with our overall financial plan in mind. So now once we've designed and built a plan, the final step is to protect it. Keeping your plan on track may be the most important challenge and most important part of being a long-term investor. There are several ways at Squire Wealth Advisors that we work with clients to help achieve their goals and protect their portfolios and protect their financial plans. The first is rebalancing their portfolios to keep it in line with their risk tolerance. Second, keeping up to date with any changes in our clients' lives or goals through ongoing rediscovery. Third, continuously assessing their progress toward meeting their objectives. And fourth, providing them with ongoing education and guidance to keep emotions in check. Now, this one is a lot more important and valuable than it sounds. For most of us, money is bound up with powerful emotions like security, confidence, and even sometimes fear. But the emotions of investing cause us to lose focus on important areas of our life, most of which have absolutely nothing to do with the stock market. This image is illustrating the emotional roller coaster of investing. Markets are prone to sharp and erratic movements, which can cause investors to sell at really poor times. And the opposite is also true. During strong bull markets, when the markets are doing well, investors often rush into the market because they feel elated and they buy at the peak. It's the equivalent of avoiding Black Friday sales and then finding the most expensive time of the year to buy a new iPhone. In fact, in a 2020 study by Dalbar, which is a financial company known for their independent research on investor behavior, they found that the S&P 500 returned 6.06% over the past 20 years, and the average stock investor earned only 4.25%, primarily because they tried to outsmart the market but kept getting in and out at the wrong times. This is just one example of how patience, discipline, and working with an experienced financial advisor can help protect your plan. So that's it for me. Hopefully this has been a helpful introduction to financial and retirement planning. And now I'll turn the time over to Nathan, who's going to go into greater details about some specific Social Security planning strategies.
Thank you, Clayton. I'm happy to be here as well and talk about some retirement planning, which is an area that is so important to most people. So I'm specifically going to talk about Social Security. And when I get questions from clients about Social Security, the two questions I get the most are, how much am I going to get and when should I take it? So there's a few concepts we need to go over in order to kind of get the basics down so we understand how to make a more informed decision. So you can take benefits as early as age 62. There's this concept called full retirement age, which is age 66 or 67 and in between. And I'll show up a little table here in a second that shows your full retirement age depending on which year you were born. And then you can delay Social Security as long as age 70. So the full retirement age is basically the age at which Social Security says you'll get the full unreduced benefit. So back when Social Security was created, people didn't live as long as they do now, and most people actually never even lived long enough to claim Social Security at all. And so they had this full retirement age, even lower than it is now. It got changed to age 66, and then with the Social Security system kind of being strained with people living longer and not as, baby boomers are now starting to retire. And so the system is somewhat unfunded. You hear a lot of horror stories about how it's bankrupt. Bankrupt's not the right word. It's a pay-as-you-go system. So the Social Security taxes that workers pay every year go into the Social Security system, and then those taxes are used to pay benefits to current retired folks. And so based on current conditions, the system will be only able to pay out 75% of what it's supposed to pay in like year 2030 or 2035, somewhere in there. And that's not a good thing, but my feelings are that Congress will make some changes. Eventually, they'll probably wait till the last minute, but they'll make some changes that will shore up the system so that it can continue going forward. But even if they don't, it'll still be able to pay out 75% of what it's supposed to. So it's not bankrupt. It is unfunded. It needs to be fixed, but it's not going to go away, in my opinion. So one of the things that the government did is they said, hey, people are living longer. Let's push the full retirement age up to 67. And that made some people upset, and the government can't do anything in a simple way. So they made it complicated and put in all these fractional years. So depending on which year you're born, your full retirement age, it shows it here. And that's the age at which you can get an unreduced full Social Security benefit. To calculate your benefit, so first off, I guess to qualify for benefits, you have to have 10 years of work or 10 years of paying into the Social Security system. The 10 years are broken down by quarter, so it's really 40 quarters, which equals 10 years if you do it consecutively. It doesn't have to be consecutive, though. It just has to be 40 quarters of paying into the system, either through Social Security taxes being withheld by an employer, or if you're self-employed and pay self-employment tax on your tax return or with your tax return, then you get credit for that quarter. All right, and then once you qualify, they take all your earnings actually over your lifetime, all of your earnings subject to Social Security taxes, and they index them to make them comparable because of inflation. And then they take the highest 35 years from that history and average those, and that's how they get the base amount that goes into the formula. So we had that slide up there that said you could take benefits as early as age 62 and then as late as age 70, and the timing really makes a huge difference on the amount of monthly benefits that you get. So here's a little bit of an example. This person's full retirement age is 66, and so if you look right in the middle of this graph here, their monthly benefit is $1,800. If they were to take it early, let's say they want to take it as early as age 62, their benefit gets reduced 8% each year that it's early. And so, for example, our $1,800 monthly benefit is now $1,350. And then if they were to delay taking benefits, you earn what is called a delayed retirement credit, which is an 8% increase in future benefits. So this person, if they wait till age 70, their $1,800 a month benefit is now $2,376. And just comparing the very beginning, age 62 with age 70, it's a 76% increase. And so generally, the longer you can delay taking benefits, the better off you're going to be in the long run. You have to factor in lots of different things, health, spousal benefits, which we'll talk about, other assets that you might have that you could live on if you were going to really stop working but still wanted to delay taking Social Security. Lots of things to consider. One thing that I wouldn't really consider, I get this question quite a bit, is why don't I take benefits? I don't need the money, but I'll go ahead and invest those dollars, and I'll have the money now and then I'll invest it. Well, that's definitely possible, but the increase in benefits is 8% per year, government guaranteed, which you're not going to be able to find any investment out there that will return that high of an investment return and have a government guarantee. So I'd caution against that strategy. The other thing is to think about is your biggest risk in retirement is outliving your assets. So it's living a long time and basically running out of money. And delaying Social Security can buy you some protection against longevity. The longer you wait, you buy yourself a bigger monthly payment forever, for as long as you live. And if you're married, we'll talk about survivor benefits, but you're also buying your spouse a bigger benefit if you were to pass away before your spouse. Working does affect your benefits if you take them before your full retirement age. So there can be a benefit reduction. So if you wanted to start benefits but continue to keep working, you can only earn $18,240 before Social Security reduces your monthly benefits. And the formula's there. They reduce it $1 for every $2 that's over that limit. The year you reach your full retirement age, there's a little bit bigger earnings limit there. And that's just because not everybody retires right at the end of the year. You might have somebody retire in the middle of the year, and so they've got higher earnings. They've got a partial year of earnings that year they retire, and so you have a bigger limit. It's $48,600 in 2020, and they don't reduce it as quickly. It's $1 for every $3 that's over that limit. Once you're at your full retirement age, there's no earnings limit. You could earn as much as you wanted if you wanted to continue to work, or if you get bored during retirement and you go get a second job or something to fill up some time, and maybe it's a job that you wanted to take and never really were able to, something like that. It doesn't matter. You're able to earn as much as you can or want to, and your Social Security benefits won't be reduced. Now, if you do work and you have this benefit reduction, it's not lost forever. What they do, the Social Security office will kind of suspend those benefits, and then when you do hit your full retirement age, they will reallocate those over your expected lifetime. So you'll get a little bit of a bump up. My thought here is if you plan on working, you're probably better off just waiting to take benefits till at least your full retirement age. There's maybe one case if you had an older spouse or something that it might make sense to claim benefits early and continue to work, but in most cases, you're better off just delaying. I'm going to talk a little bit about taxes quick. Your benefits are potentially taxable when you receive them. And it depends on what your overall income is. So they're looking at combined income on your tax return, which equals, it's not your taxable income, it's your adjusted gross income plus any non-taxable income plus half of your Social Security benefits. If that combined income figure is less than $25,000 if you're single or $32,000 if you're married and filing a joint return, then you won't have your Social Security benefits won't be taxed at all. If you're above those limits but below the next threshold, which is $34,000 for single and $44,000 for married filing joint, then 50% of your benefits are taxed at your ordinary income rates. And then if you're over those two limits, the $34,000 or the $44,000, then 85% of your benefits are taxed. So sometimes when I've done these presentations live, I get people with big eyes here. It's not an 85% tax rate. It's that every dollar in Social Security that you earn, 85 cents of it is taxable at whatever tax rate, tax bracket that falls into on your tax return. Spousal benefits are a big deal, and often I talk to people and they don't even know that the spousal benefits exist, and they're pleasantly surprised when I describe how it works. So spousal benefits are a 50% benefit of your spouse's full retirement age benefit. So let's go back to our $1,800 a month example. That person's benefits at full retirement age were $1,800. Their spouse, if they were married, would be eligible for half of that, or $900 per month, under the spousal benefit rules. And in order to get that spousal benefit, the first spouse has to be taking benefits. And then the next thing is they look at the age at which the spouse claims the spousal benefit. So if they wait till their full retirement age, they'll get the full benefit. If they're taking it early, they get that 8% reduction as well on the spousal benefit. And one thing that's different on the spousal benefits is you don't earn the delayed retirement credits. So the $900 would be the maximum spousal benefit in our example. And if the spouse decided to wait, they wouldn't earn any delayed retirement credits on the spousal benefits specifically. And if, sometimes you've got spouses that have worked and have qualified for their own benefits. If that's the case, you don't get both benefits. You get whichever one is bigger. So sometimes if the second spouse has worked quite a bit and earned themselves a nice Social Security benefit that's more than the spousal benefit, they'll get that. If they haven't worked at all, or very little, then the spousal benefits kick in and can make a big difference in someone's retirement plan. And it's good. It's a good thing because, in a traditional household, maybe one spouse was at home raising children and didn't have the opportunity to work and earn Social Security credits. And this is the government's way of putting some value on that activity. So I'm just going to skip that. Okay, survivor benefits. So survivor benefits you're eligible for those as early as age 60. There are some other cases if there's dependent children or disabled children that you're caring for, and primary earning spouse passes away, then you can get some benefits that way. But if all children are raised and there's no disabled children, then it's as early as age 60. And if you've got somebody who's already on Social Security benefits, they're already claiming their own benefits. So let's go back to our example, the $1,800 a month benefit, and then we were also getting the spousal benefit of $900. If one of those spouses passes away, the remaining spouse will get the $1,800 a month benefit, and the $900 one will go away. And so that's where this is one of the reasons why delaying benefits can be a good idea, because life expectancy is something to consider, and joint life expectancy is very important. There's a pretty good chance that at least one spouse will live past age 85. And I think there's even a somewhat decent chance that one spouse will live past age 90 if you're just looking at Americans, age life expectancies. And so delaying benefits will buy a bigger monthly payment for, both of you, obviously, regardless of who dies first. And so if you've got one spouse that maybe doesn't have very good health, sometimes the inclination is, let me jump in and take benefits right away because I'm not going to live very long. But you do have to kind of factor in your spouse. If your spouse is healthy and they're going to live a lot longer, you might still want to delay to buy your spouse a bigger monthly payment after you're gone. So the thing with Social Security benefits is everybody's situation is so different. You've got single people, married people, different ages of spouses, some same age, some older, some younger, some lots younger. All those things go in to consideration on what an optimal claiming strategy might be for somebody. We like to sit down with people and look at their earnings histories and run numbers and put it into their financial plan, and then we can usually get a recommendation that makes sense and that clients are comfortable with, and then at least provide the information they need to make the right decision for them. There used to be a few more tricks or strategies we could implement. One of the things Social Security has done over time is made changes. We talked about the full retirement age changing. They've also changed a few of the things along the way to try and shore up the system a little bit more. This strategy, this restricted application strategy, only makes sense if you're born before January 2nd, 1954. But basically, one spouse files for retirement benefits on their own earnings record. The other spouse files a restricted application, so they file for the spousal benefits only. And that allows their own benefit to keep growing, and maybe they wait till 70 and they've kind of collected some Social Security benefits and then bought themselves a bigger monthly payment by delaying. So one strategy that works, it's kind of getting phased out, but it will work for a few more years as long as you're born before this date. If you are, reach out to us. We're happy to sit down with you and run numbers and see if it makes sense to do something like this for you. That is all I had on Social Security benefits. They are really important. The claiming strategy and timing is vitally important to most people's retirement planning. And so think about this when you're a couple years out of wanting to retire, or even when you're doing your planning and kind of knowing when you can retire. It's good to look at your Social Security benefits and do some upfront thinking and planning on what might make sense. And we're here to help. We do this on all of our client engagements that we're setting up, doing retirement planning on. We're happy to give you a recommendation and at least help you understand what you're looking at here. Next, Lincoln Fleming is going to talk about some more specific retirement strategies.
Thanks, Nathan. Hello, everyone. So I'm going to cover 3 topics today that are very relevant for those in or near retirement. And those are Roth conversions, qualified charitable distributions, and recent changes to the required minimum distribution rules. So let's start first with Roth conversions. A Roth conversion generally refers to taking all or part of the balance of an existing traditional IRA and moving it into a Roth IRA. There can be a number of benefits to doing this. I'll cover 3 of them today. One benefit is being able to take tax-free withdrawals in retirement. When taking withdrawals from a traditional IRA, you generally have to pay taxes on the earnings and growth within the IRA, as well as on any contributions originally deducted on your taxes. With the Roth IRA, however, as long as you meet certain requirements, all of your withdrawals are tax-free. Another benefit of a Roth IRA is that your money grows tax-free for longer. Traditional IRAs generally force you to begin taking required minimum distributions every year after you reach age 72, regardless of whether you actually need the money or not. So you lose the tax-free growth on the funds that you have to withdraw. On the other hand, Roth IRAs don't have required minimum distributions during your lifetime, so your money can stay in the account and continue growing tax-free. A third benefit of a Roth IRA is that you can leave a tax-free inheritance to your heirs. The people who inherit your Roth IRA will have to take required minimum distributions, but they generally won't have to pay any federal income tax on those withdrawals. Deciding whether or not to convert a Roth IRA is an important decision because once you've done it, you can't revert the money back to a traditional IRA. And so there's a number of factors you'll want to consider before pulling the trigger on a Roth conversion. One of the most important factors you'll want to consider is whether your tax bracket is higher now or if it will be higher later on. Obviously, nobody really knows for sure how tax rates could change over the next 5, 10, or even 20 years. However, if you believe your tax rate is lower now than it will be when you start taking withdrawals, a conversion can be very promising because you'll pay conversion taxes while you're in a lower tax bracket and enjoy tax-free Roth IRA withdrawals later. But if you believe your tax rate is higher now than it will be when you start taking withdrawals in the future, a conversion could cost you more in taxes now than you'd save with tax-free withdrawals later. And then another consideration is whether you'll end up in a higher tax bracket as a result of the Roth conversion. All or a portion of the money you convert may be considered income by the IRS when converting. If you're on the cusp of the next tax bracket, there's a chance you'll get bumped up into a higher tax bracket in the year that you convert. To avoid this, consider converting just a portion of your traditional IRA in any given year. This can help you stay out of a higher tax bracket and help spread the taxes related to the conversion over several years instead of getting hit with the entire tax bill in one year. And a third consideration when doing a Roth conversion is, where will you get the money to pay the conversion taxes? Generally, you'll want to pay the tax from the conversion with funds outside of your IRA, since taking money out of your IRA to pay conversion taxes would be considered a distribution, which could result in higher taxes and potentially a 10% tax penalty, depending on your age. So if you don't have sufficient outside funds to pay the taxes, it may not make sense to do a Roth conversion. Certainly there's times that are more beneficial than others to do a Roth conversion. Beneficial times to consider doing a Roth conversion include when asset values are temporarily depressed, such as when the stock market takes a nosedive, which we saw earlier this year. You have large deductions or losses to offset the conversion income, or when you're in a lower than usual tax bracket, such as due to a loss of employment or early in retirement before you begin taking Social Security and before you begin having to take required minimum distributions from your tax deferred accounts. So the second topic I want to cover today is qualified charitable distributions, or QCDs for short. A QCD is a direct transfer of funds from your IRA custodian payable directly to a qualified charity. In addition to the benefits of supporting charitable causes, a QCD also excludes the amount donated from taxable income without having to itemize your deductions. So you can receive a tax benefit for charitable giving while being able to take advantage of the standard deduction. Not including the qualified charitable distribution and income may help you qualify for certain tax credits and deductions that phase out at higher income levels, or potentially avoid exposure to taxes that kick in at higher income levels. And just to clarify, since the QCD amount is excluded from income, you don't also receive a charitable deduction for the QCD. In order to make a QCD, you must be age 70 and a half or older at the time the distribution is requested. Additionally, the maximum annual amount that can qualify for a QCD is $100,000. This applies to the sum of QCDs made to one or more charities in a calendar year. However, if you do file jointly with your spouse, both you and your spouse can make a $100,000 QCD from your own IRAs. If you are required to take required minimum distributions, a QCD can count towards satisfying your RMD. However, any amount donated above your RMD does not count towards satisfying a future year's required minimum distribution. Funds distributed directly to you, the IRA owner, and which you then give to charity, do not qualify as a QCD. The funds must be transferred directly from your IRA custodian to the qualified charity. And in order to qualify as a QCD, the charity must be a 501c3 organization that's eligible to receive tax-deductible contributions. And the third and final topic I'm going to cover today is recent changes to required minimum distribution rules for retirement account owners. A required minimum distribution, also known as RMD, is the amount of money that must be withdrawn from certain types of retirement accounts or plans each year, such as traditional IRAs and 401ks, by owners and plan participants of retirement age. It's important to keep in mind that RMDs are the minimum amount that must be distributed each year. Retirees can, and often do, take out more than the RMD, which is fine. The RMD rules are designed to prevent people from keeping funds in their retirement accounts indefinitely and avoiding paying taxes on those funds. Failure to take a required minimum distribution can lead to a 50% excise tax, so it's really important to be aware of the rules and to stay on top of your RMDs. Prior to the Secure Act, which was passed in late 2019, required minimum distributions started in the year a person attained age 70 and a half, with the first distribution delayed to the following April 1st. The Secure Act changed this date to April 1st of the year after someone attains age 72 for those born after June 30th, 1949. Overall, this is a very taxpayer-friendly change that allows retirement funds to continue to grow tax-deferred for longer before taxpayers are required to begin taking distributions. And then finally, one other recent change to the RMD rules is that RMDs were suspended for 2020. So this gives accounts more times to recover from the stock market downturn that we saw earlier this year. So that's the end of our presentation today. We appreciate you joining us. Before we go, we're happy to take any questions if anybody has any questions about what we've covered today.